Welcome on board to Chapter 17 of VCE Accounting, Unit 2, Area Study 1, where we're going to be looking at inventory and learning intentions to understand the importance of inventory to trading businesses, to understand the perpetual inventory system, to be able to use the two techniques, identified cost and FIFO, for recording inventory movements and valuing inventory, and to be able to identify and record inventory gains and losses. All right, let's go. So, what's the importance of inventory? So, I want you to pause this video quick, and before I reveal the answer, I want you guys to think about it. What is inventory, and why does a business value its inventory? So, inventory, so they're goods that are purchased for the purpose of resale. So let's say I have a drinks business. I buy vanilla milkshakes and I sell them in packets. I sell them in boxes. That's my inventory. The milkshake box is my inventory because I'm selling it. I'm buying it from an external source and I'm selling it. So an inventory is the main source of revenue for a trading business. So trading businesses use inventory to earn a profit. Unsold inventory is likely to be one of the most significant assets in the balance sheet. So determining the cost prices of inventory. So the cost price is the price of a business purchased inventory reported in the business balance sheet. There are several different ways of determining the cost price of inventory. Some of the most common methods are using the markup applied to an inventory. So like we mentioned before in chapter 12, we looked at a percentage markup. So that's one of the methods. The second one is using codes on price tags, which disguise the cost prices from customers. So I guess you've seen that a lot in like stores like IKEA, Kohl's, etc. And then finally using different colored tags or labels to indicate different cost prices. So yeah, again, that's pretty common. So the markup method. If an owner applies a fixed markup to all inventory items, it is possible to work backwards from selling prices to determine the cost prices. So let's say a markup of 100% is the easiest to work with because all you do is calculate 100% of the item, which is the cost price of the item, and then simply 50% of the selling price. An item selling for $20, let's say, must have been purchased for $10 because you're adding 100% to 10 to get 20. So an item selling for $15 would have been sold for 7.5 because again, you're calculating 100% of $7.50 and you're adding it on again. So if 100% markup was not used, the following formula can be used to determine cost prices. So the formula is sales price equals the cost price times markup plus 1. So I'm sure in my in the first part video, I've showed you guys how to use the 1 plus method, where you just plus 1 with the decimal point of your percent. So let's say I want to mark up a item of, let's say 50% up. So I do the cost price multiplied by 1 plus the 0.5 to get the sales price. As simple as that. So now let's look at the perpetual inventory system. So what's a perpetual inventory system? It's a continuous inventory recording system. So all movements of inventory are recorded on inventory cards. So on the system, whatever product or type of inventory a business receives, or a business sells, or a business loses, all types of movements that are regards to the inventory of a company, that those are recorded on what's called an inventory card. So we'll learn about inventory cards in this lesson. Let's move on. So every individual line of inventory has a separate inventory card. So let's say, for instance, you have two pieces of inventory. You have a tomato soup, and you have a let's say an up and go milkshake drink. So those inventory, they're not the same. They're not part of the same branch, which means they must have a separate inventory card itself for each line. You can't expect a tennis racket to have the same inventory card as a, let's say, a pair of shoes. So like that, every business has for every line of inventory, they have a separate inventory card. So a physical stock take is conducted to verify the accuracy of the inventory card. So what's a physical stock take? It's basically where employees of a company, of a business, do a check around the whole store. They take a physical check around how much inventory is there, and they make a cost price of each inventory, and then yeah, it's they go around the business, they go around the market. I presume, let's say they do a physical stock take for Coles. They go around every shelf, they calculate how much of each item, each inventory product there is. They determine the price, and then yeah, they make a check like that. So this helps obviously to identify any inventory gains or losses. So let's say due to like theft or a inventory error, recording error, that one item, let's say tomato soup, there's 5 less. Well, a physical stock take will help identify what the true inventory gain or inventory loss is. All right, so recording inventory transactions. So let's consider this. Let's consider this example. So LeBron's Lounges purchases inventory. So five lounge suites from Cleveland Couches for $4,000 plus GST using check 23. All right. So what's the effect on the accounting equation? So firstly, the assets decrease by $4,000. Well, they're spending their own money. They're spending their business money to buy couches. So that means it's a decrease in the bank. Like I said, when you're using cash, it's a decrease in the bank by 4,000, and the bank decreases. So the inventory increases by 4,000, right? Because you're purchasing lounges, so that means the inventory increases, but the bank decreases by the total amount, which consists of the cost price plus the GST. So the balance would be $400, or you can say negative $400. So now to balance that out, the GST is not a form of owner's equity. It's not capital. So it has to be a liability because you're owing that money to the ATO. Remember, any form of GST is a form of tax which you have to owe to the ATO. That's why it's a liability. So the GST liability, GST payable, is also becomes negative 400. So it balances out on the left side and the right hand side. All right, so recording inventory transactions. So okay, let's say selling inventory. LeBron's Lounges sells one lounge suit to a customer for 1,500 plus GST. So the lounge suit had a cost price of 800. So the effect on the accounting equation. Well, with that previous example, I want you guys to pause the video and try it yourself, before I just say the answer. But yeah, so the assets increase by the bank increases by 1,650. Remember, you're having the total amount, which is the cost price plus the GST. All right, so it's 1,650. So remember, some scenarios don't give you the GST, but you'd have to use your own knowledge to calculate it. So if you have $1,500, then the GST would be 10% of that, so which is 150. So you just add 150 to get 1,650. And then the inventory decreases by 800. So the total value in the asset section is 850. So of course, given that, you have to balance it out on the equity section with 850 as well. So now the only liabilities here is GST payable, which is $150, and then owner's equity, which is $700, because that's the residual amount that you have, let's say, like profit. It's not really profit, but like it's, it's a form of owner's equity slash capital. So, all right, recording inventory transactions. So inventory can also be affected by several other types of transactions. So let's say the effects of inventory through other transactions can be through the owner withdrawing inventory. So let's say you own a business that's selling fruits, right? You're selling groceries, and for your personal use, you're withdrawing some of the groceries. You're withdrawing, let's say, 2 bags of groceries for your own use to cook meals at your house. So for that cause, you're incurring an inventory loss, right? So that's in terms of the business. Remember, in accounting, we're always talking in terms of the business. So the next one is inventory being returned by customers. So yeah, of course, that's seen in many places. So let's say, for instance, Kmart, you buy a product, you don't like it, and you just return it with the receipt. Remember, receipts are the source documents that you need for inventory being returned. So in that case, they have an addition in inventory, and they can resell that. So third one is inventory being returned to customers. Remember, when you're thinking about it, think about it always in the business's perspective, not the customers or suppliers. So the last one is inventory being used as advertising slash donation. So yeah, we've also seen that some inventory is being used to advertise the business. Now these transactions must also be entered onto an inventory card. So yeah, remember, the inventory card calculates all changes or all effects on inventory. So all right, we'll look at inventory cards now. So we've discussed what an inventory card is. Now we'll actually take a look at what an inventory card looks like. So to begin with, this is how an inventory card is set up. So you have your date, of course, when the transaction happened, when the effect happened, and then you have your details. Well, in your details, if you're recording what's in the inventory already, you just put the balance, just input the balance here. But otherwise, you're just entering your source document. So let's say you have a inventory gain or inventory loss. You have you're recording it in a memo. So you just record your inventory loss in this row, and then you put a memo with the number, and then let's say you put a receipt, you put an invoice. So that's the source document on the details. Now you have your in section, obviously the inventory that comes in with the quantity, the unit cost, and the total value. Remember, unit cost is how much the item costs for 1 unit. So for 1 apple, let's say a bag of 20 apples costs $20. So in that case, the unit cost for 1 apple is $1. And the total cost, if the quantity is 20, it's $20. So now the out section is self-explanatory based on the in column. So you have obviously you have inventory going out. So same thing, but it's going out instead. Now the balance recorded of each type of inventory, you have to record, okay, if inventory comes in to the business, then the quantity becomes bigger, obviously, it becomes more. There's more because you're getting more. So now, given that you have an inventory, you have inventory coming out of your business, then the balance is decreasing. So right, this is a general gist of what inventory card is. Now, there are certain rules that we have to follow for inventory cards. You can't just record it, randomly. You can't record it like that. There's a couple of rules. So the first one is the cost price recorded on inventory cards is the cost price. So you don't add extra amounts. You don't add GST, right? You don't add any form of tax. So that comes to the second rule, which is no GST is ever recorded on inventory cards. All right. Now the third rule is inventory is recorded in the order in which it enters the business. So first in, first out. So in our learning intention, we briefly talked about first in, first out, which is FIFO, known as FIFO, and identified cost. So we're going to be recording our inventory in an inventory card using identified cost and FIFO. These are two critical techniques that businesses use on a day-to-day basis. And then the final one is any difference between the last balance and the physical stock take must be recorded on the inventory card as an inventory gain or inventory loss. So yes. So what's a physical stock take? So a physical stock take, like we discussed, it's where an employee of the business goes around the store and takes a physical check around the piece of inventory that are there to confirm whether there's inventory loss or inventory gain. So yeah, at the end of every reporting period, a physical stock take should be completed for all trading businesses. So a stock take involves two distinct processes. So remember, when there's a stock take, remember these two pieces of information. First is a physical count of the number of inventory units on hand. All right. So like we said, how much of each product is there on each shelf of a business. So for Coles, for instance. So second, determining the cost price of each inventory item on hand. So yeah, again. So let's move on. So physical stock take. Well, okay, there are certain aspects we have to consider. So for inventory losses, certain reasons could be theft. So let's say a store has a burglary, theft of inventory, which results in inventory loss. Damage of inventory, of course, wastage. You have to when the inventory gets damaged, you have to throw it away, especially food and products. So oversupply to a customer, of course, when you're giving more than required, than paid for, of course you have inventory loss. Same goes with undersupply, and then recording errors on an inventory card. So inventory loss is an expense. Well, that's given. Just remember, loss is an expense and a gain is a revenue. So for inventory gains, however, you have an undersupply to customers, oversupply to suppliers, right? So basically this they're switched out. Remember, for inventory loss, it's an oversupply to a customer because you're giving more than you need. For an inventory gain, it's an oversupply to a supplier, right? Because you're also giving more than required. But it's an undersupply to customers if you have an inventory gain because you're giving less than what they paid for. So you have more you have a more leftover amount of inventory. And yes, an undersupply to customers, well, you're giving less than what they paid for. So now we're recording inventory gains and losses on an inventory card. So when we look at an inventory card, well, this is an example. Now, we have all the transactions, we have all the effects that happened between August 1st to August 6th. However, there's something new that hasn't been recorded, and basically it's an inventory loss. So let's say this company, Megafast Computer, let's say they sold computers. So what happened on the 6th is that let's say one computer got damaged, or there was theft in this company. A few burglars came and stole a computer. Now, how you record that is, of course, is it going in? When you have an inventory loss, is it coming into the business or is it going out of the business? Well, of course, it's a loss, so it's going out. So you record this as an inventory loss in the out section. So in the last last row, you have so this happened on the 6th of August, right? And well, of course, it's only one piece of inventory that's lost. So you record this, um, the quantity being one, and then the cost. How much does the computer cost um, per unit per computer? So since it's 1,300 and the quantity is one, total price value is 1,300. Now, of course, what's the balance of this type of inventory? There was 10 left, right? So a balance of 10. Now what happens is there's one less. So 10 minus 1, 9. There's 9 left. So 9 times 1,300, 11,700. Now remember, inventory losses and gains are always recorded with the source document of a memo. Remember? So when inventory comes in, you have an invoice. When inventory goes out, you have receipts. Remember, when you go to Kmart, you go to Kohl's, when you buy groceries, let's say your self checkout, yeah, you're going through a self checkout, or you're going through a counter. The always the employee will give you a receipt because you're making the purchase, and that's the source document that will give the total amount, right? So you have a receipt for when inventory is going out, right? Think of it like in the perspective of the business, not the supplier or the customer. So an invoice is when you have inventory coming in from the suppliers. Yep. But an inventory loss is recorded on a memo, remember, and an inventory gain. So yeah, inventory gains, again, it's the same thing as before. When you have one extra computer, let's say some suppliers oversupplied you by one computer, you record that in the in section by one. Yet again, this much, and you have one more, so you add it, so now you have 11 in total, and again it's recorded on a memo. So all right, so recording sales returns and purchase returns in this case. So a purchase return, so let's say you have you're the business and someone came to your store, they bought a product, they bought let's say they bought a candle. So let's say when they went home, they still had the receipt, but they did not like the color, did not like the fragrance of the candle, so they decided to come in and return it. How that is, now a purchase return. So it's recorded in the out section, right? When you have one energy loss, right? So you purchase, let's say you're a business, right? You purchase it from the supplier, right? Now you want to return that product to the supplier. Let's say the candle example, that that external business is selling the candle, and the person that bought the candle is you're the business, right? You bought the candle, but you don't like it, so you're returning it, right? That's recorded in the first business's inventory card in the out section, because it's going out from your business, so you're losing one piece of inventory, so you're having one less. So like an energy gain and energy loss, right? It's the exact same thing, but it's recorded on a credit note with the source doc. So the source document for purchase returns and sales returns is a credit note, whereas for it's a memo for energy loss and energy gains. So yeah, sales returns as well. This time sales returns, you have it in the in section because you're making a sale and someone returns it to you, so you have more energy left. So of course that remains in an addition of inventory. So alright, and alright, quick thing, when we have FIFO, we're always assuming that let's say in this card, which piece of information, which piece of inventory came in first. Well, on August the 3rd, you had, okay, let's say August the 1st, you had a quantity of 3 of $50 of 150. So of course that came in first, right? But on August the 3rd, that came the third, I mean, the inventory that costed $50 came in first. So that's the one that's going out first. So let's say if you sell the piece of inventory, you sell inventory, and the question in a sack doesn't give you what inventory you sell. You automatically, in your response, you say that you sell the one that's costing $50 as opposed to one that's costing 55, because that's the one that came in first to the business. So that's the one that's going out first. So yeah. So now, why do we use a perpetual inventory system? So identifies when inventory needs to be reordered. So yeah, and identifies fast and slow moving inventory items, right? Inventory gains and losses can be detected. So yeah, like we said, on an inventory card, you can detect an inventory loss or an inventory gain. We can prepare an income statement at any time. So yeah, with an inventory card, you can determine the revenue made and the expenses. So the losses and the revenue. So you can put that information in an income statement at any time. So yeah. Right, so based on the content we learned, we have an exercise. We have a practice question here. So exercise 8.2, we're looking at inventory cards with identified cost. So Casey's Cabinets uses identified cost to value its inventory, and as of 1st of May 2025, had on hand 40 glass-fronted cabinets with the inventory code GF900, which had purchased for $240 plus GST each. Alright, so during May 2025, the following transactions took place from the 2nd of May to the 31st of May. Alright, so let's see what the question's asking us. So record the transactions for May 2025 in the inventory card for GF900 glass fronted cabinets. Alright, so sweet. So here's our inventory card, and yep, this is how it's set up. Like we discussed in the content slides. We have the inventory item, which in this case is glass front cabinets, and then the inventory code is GF900. So pop that in. Okay, and then the supplier, if you go through this information, we have been given that the supplier is Pine Products. So yeah. So alright, let's start off. So on the 2nd of May, so okay, with the first piece of information, with these questions, typically, I think looking at reading the top first. So this part is important because it has the transaction that, or like the effect that happened on the 1st of May. So it technically doesn't start from the 2nd of May. So they mentioned that the value of inventory on the 1st of May had on glass 40 glass fronted cabinets. So all right. So we're given that which each costs $240. So okay. So on the 1st of May, so remember, for our details, we either put the balance or the source doc, but since there's no source document here, and it's how much of inventory there is in the beginning, it's known as a balance. So now for this part, since it's the balance, there's 40 glass fronted cabinets, which I'm pretty sure they cost $240. And then we total this, so 9,600. All right, so that's for the first, and we'll to distinguish between each individual effects, we will shade this. All right, so now for the 2nd of May, we have purchased 20 cabinets for $250 plus GST, each from the Fisher Furniture. So, and then we're given a source document invoice. All right. So 2nd May. Now we put the source doc here, which is invoice C745. C745. Okay. Now what they tell us to do. So they purchased 20 cabinets for 250. So in this case, there's a new piece of inventory that's added, right? The first initial piece of inventory that was there was the $240 one. But now there's an addition of the $250 one. So what we do is we record the balance of the previous one that was already there, because that's already in the balance, or that's already in the business, what the business already has. So we record this as it is. But now, what effect did it have? So in this case, they said they purchased 20 cabinets for 250. So it's coming in to the business, right? So 20 cabinets, each costing $250. And then you have 20 times 250, which is 5,000 total. And then here, since there's a new piece of inventory added, you record the balance of the new piece of inventory, which is there's 20 of the $250 cabinets, and in total its value is 5,000. So that's for the 2nd of May. Now we will go to the 4th of May. I'm pretty sure that was the next one. So the 4th of May. Did they give us a source doc? Yep, invoice 76. Okay, 76. So okay, let's see what they're asking us. So sold 35 cabinets at a selling price of $500 plus GST. All right, sweet. So each to so they said 23 cabinets were valued at 240 and 12 were valued at 250. So they sold. Now the keyword is sold here. Now, meaning, since it's sold, it's going out of the business. So right now we think about it like this. 35 cabinets, but 23 of them were valued at 240. So let's record that. So 23 went out at $240, and you, of course, 23 times 240. Yep, that amount. And let's see what else they said. 23 of the cabinets were valued, okay, and 12 were valued at 250. So now 12 were also sold for 250, which is a different cost price to the above, right? Okay, so if we add this, if we multiply 250 by 12, you get 3,000, and now it's recording the balance. So it went out of the business, so that means that now for the 41, there's 17 left, because 40 minus 23 is 17, and then they're valued at $240, and then we multiply these two, and you get that. You get 4,080. So now we'll do the same for the other piece of inventory, which is $250 in value. There's 20 of them, and the business sold 12 of them. So how many are remaining? 8. And we're at 250, and yep, if we 250 times 8, just 2,000. All right, so we will color code that as well, to make it distinguishable. I don't think on a sack you would be able to do that, but yeah, just for reference. So all right, we'll go to the next transaction, next effect. I mean, so May the 7th. Now it's a memo. So what did we say that memos are for? Okay, so when we record this, we'll put the source stock here, and so that's a memo 34. Okay, now let's see what the question's asking us to do. So on the 7th of May, Casey took from inventory 2 cabinets with an identified cost of $250. All right, so we already know that we have an inventory worth $250, and they took 2, so it's like a withdrawal. So which are always recorded in a memo. So they're not selling it, but they're taking it out for personal use. So in this case, it is going out of the business to 50, and then yeah, of course 2 times 250, 500. Now which piece of inventory did they take? So 241 is not affected because it still remains, right, in the business. So that's just the same as here. Now what is affected is the other piece of inventory, the $250 one, of which there are 8. But from the remaining 8, there's the owner withdrew 2. So how much are left? 6, which are worth 250, and then 6 times 250, which is 1,500. So that's it for the 7th. Let's go to the next one. So the next one, okay, 12th of May, they gave us a credit note. Okay, so 12th of May gave us a credit note, which was credit note 21. All right, CN21. All right, so they said GQ Design returned 5 of the cabinets. So remember, as we talked about, inventory gains and losses are recorded in a memo. As we talked about in a content slide, in the content slides, memos are used for recording inventory gains and losses, whereas credit notes are used to record sales returns and purchase returns. So in this case, it is so GQ Design returned 5 of the cabinets purchased on 4th May. So okay, so the cabinets were identified as having a cost price of 240. So let's go to the quick 4th May, and they said return 5 of the cabinets purchased on 4th May. Okay, so they returned 5, right? Which means that they're worth 240. So we have 5 going in back to the business because the external business returned 5 to our business. So we get 5 more because it's a return. So we have 5 more pieces of inventory, right? Now 5 times on the 240 is 1,200. Okay, now okay, this part, the balance, so 5 came in, right? 5 came into the business, so which are worth 240. So now all you do is the 17 that was left over, all you do is you do 17 plus 5, 22 piece of inventory now for $240 one, and of course you multiply both of them, and now of course the 250 piece inventory is not touched, so that remains the same. I will color code this. So yep, now let's go to the next effect, which was the 15th, So returned to Fisher Furniture the 5 cabinets returned by GQ Design for a total credit of 1. Okay, now this is also, you know, recorded in a credit note, right? So the 5 that were here, right, they said returned to Fisher Furniture. So originally where we bought it, we returned it. So it's a purchase return because we purchased it and now we're returning it back to the same business. Before it was a sales return because we sold it and GQ Design returned it to us, but now we are returning it to Fisher Furniture where we originally bought it. So returned to Fisher Furniture the 5 cabinets. So let's see where that goes. Now when we return something, it goes out of the business. So okay, I'll quickly put the date and then the what was the source stock. It's a credit note A56. Okay, CN A56. Okay. Now with this scenario, since we're returning it, we are returning it. We're giving it back to the original supplier. So it goes out of our business. The $240 inventory, 5 of them go out of the business. So 5 times 240, 1,200. All right. Now since they go out, the 22 quantity reduces by 5. So now it's 17, 240, and then it's the same value here, which is 4,080. And then of course the $250 inventory is not touched, so it remains. So now we are going to the next effect, which is the 19th. So purchase 30 cabinets at 286 including GST. So let's see here. Now if you think about it like this, yeah, they said including GST, right? We're not given any so they didn't mention a original cost price. They mentioned the total price, so we have to assume here. So we can think of possibilities. So one of the possibilities is that the cost price could be $260 and the GST could be 26, which totals to 286. So which, you know, would be the most like, because if you look at the 24th, they bought 12, they had 12 piece of inventory, they sold 12 that had a value of 260. So given that piece of information, we can relate that the 19th, the 30 cabinets were valued at 260. So what do we do now? 30 are coming into the business, so we have 30 valued at $260. Now 30 times 260 is, yep, that much. Oh, my bad. I meant to do it. So now given that we are purchasing, we get an invoice. What was it? C786. All right, invoice C786. So now in this case, it's coming to us like we said. So 260 30 multiplied by 260, which is 7,800. And now what happens? The $240 inventory is not touched, so that remains the same. The inventory with 250 is not touched, so that remains again. But there's a new addition to this effect, right? 30 are coming into our business that's worth a new cost price. So this is a separate inventory, a new piece of inventory. So we dedicate another row for a new piece of inventory to record the balance. And we remember the additional change that we added to this was just adding a row to record this information. All right, so let's color code this. All right, sweet. So let's go to the next transaction, which was the 24th of May, and they gave us a receipt 98, which was the source document. So 24th of May, rec 98. Okay. All right, so immediately you get a receipt. I want you guys to think. Okay, they gave a receipt. What could it be? What could the effect be? So you have to be in that mindset, yeah. So 24. So obviously when you sell as a business, so they sold 20 cabinets, right? For 550. Of course, there's no inventory with a value of 550. And the additional piece of information is that of these cabinets, 8 had a cost price of 240 and 12 had a cost price of 260. So let's record that. So they said they sold 8 that had a cost price of 240, and so 8 times 240. Yep. And what else did they say? They said 12 had a cost of 260. So 12 had a cost of 260. Now you multiply those, and then you get a total amount of 3,020. Now it's all you have to do is record the balance. Remember, for the balance, since you have 3 pieces of inventory, you have 3 rows and 3 columns that you dedicate. So all right, so now the 17 one, the inventory that costs 240 is reduced by 8. So 17 minus 8. Now there's 9 left over, which over 240, which is 2160. And then the 6, the inventory that's worth 250 is not touched because there's no mentions of selling the $250 one. So that remains the same. And now, but there's an effect to the $260 one, so it reduces by 12. So 30 minus 12 is 18, and now there's 260, and then 18 multiplied by 260, well, gives you 4,680. So now let's go to the next. By the way, if you guys feel confident, you can just do this, pause the video and do this by yourself if you want. Okay, so on the 28th, they delivered 4 cabinets with a cost price of 240 each to be used to display in a homemaker center. So yeah, it's a memo. Like we mentioned, it's inventory loss because we deliver it's used for advertising, right? In this case, so through advertising, we losing 4 cabinets, right? So on the 28th of May, we have, what was it again? It was a memo because it's an inventory loss. So it's a memo 37. All right. Now there's 4 coming in. There's 4 coming out of the business because we are losing 4. So it's 4 cabinets, $240. So it's going out of the business. So there's 960 left. $960, which is the total value. Now, for the one that costs 240, you're minusing it by 4, so it's 5. Now 240, and then total 1,200. And then the 6 one, you don't touch it. It's 1,500. And then the 18 one, the $260 one remains the same. So let's just color code it to differentiate. So alright, now the 31st of May, that's the last one, I'm pretty sure. Sold 15 cabinets to GQ Design at a total invoice price, So invoice 89, all these cabinets for from the inventory purchase on 19 May. Okay, so they gave us invoice 89. So in 89. Okay, now what else did they give us? They said sold 15 cabinets, so that means it's going out of the business, and each are worth 260. Because if you put it in your calculator, and if you think about it, the last part of the question is 19th of May. All these cabinets were from the 19th of May, which is worth 260. So you know that the cost price is 260 per unit. So in the out section, there's 15 going out for 260, and total of 3,900. And then when you record the balances, this remains the same, $240 inventory, and $250 one also remains. But there's a change to the 261. In this case it minuses by 15, 260, and then 3 times 260, so 780. Yep. So there's our inventory card, right? Finished identified cost inventory card. All right, let me mention that here. Identified cost, not FIFO. Okay, so this is what it looks like. Alright, so now we have exercise 8.5, which is inventory cards using FIFO, first in, first out assumption. So Eclipse Trading uses FIFO to value its inventory, and as at 1st of Jan 2025 had on hand $5,000 worth of picture frames with the inventory code 45B. This was made up of 50 frames of $40 each, which had been purchased first. So key bit of information there. And 60 frames at $50. So we have the information here from Jan the 3rd on to 30th of Jan. Remember, we can't forget 1st of Jan as well. So let's see what the question is asking. So record the transactions for January 2025 in the inventory card for 45B picture frames. Alright, so let's make another inventory card. So this time just copy this and we'll paste it here. Now we'll do cancel all of this. What you can do is simply cancel it out, and then we'll make it no fill. Alright, so for let's see the first piece of information. So on the 1st of Jan had on hand 5,000. This was made up of 50 frames and 60 frames. So we have 2 bits of inventory now. So let's record this. So we have on 1st Jan, it's balance, because it's what's in the inventory in the initial stage. They said 50 pieces of $40, which is 2,000. And then they also said 60 frames at $50 each. So 60 frames at 50 is 3,000. And yes, it adds up to 5,000, which confirms that. So now let's color code this. So now let's go to Jan the 3rd. So sold 35 frames with invoice 44. So 3rd Jan, and we have our source doc here, which is invoice 44. And now since they sold 35 frames, it went out of the business. $40 each, and 35 times 40, which is 1,400. And now the balance of each inventory. So since it costs $40, 50 is 50 quantity is reduced by 35, in which there's 15 left over, and then you do 15 times 40, $600. And then the $50 one is not touched, so it still remains the same. Now we have our next effect, which is on the 5th of Jan. So they purchased 30 frames of $50. Okay, so check 243. So we'll say check 243. And what was the date? It was the 5th. It's the 5th of Jan. So 5th Jan. Now, they said they purchased 30 frames. So purchase means it comes into the business. So of course it's 30, 50, oh my bad, 50 and then 30 times 50. Yep. And now since they purchased the $50 one, nothing happens to the $40 one, so it still remains the same. But the $60 one, the $50 one, however, is impacted now because there's 30 more. 30 came into the business, so now there's 90 because it's 60 plus 30, right? 90 worth $50, and in total 500. We'll color code this as well. So now for the next transaction, so on the 10th, so sold 40 frames at 110, including GST. So they gave us a EFT receipt 68. So on the 10th of Jan, receipt rec 68. Now what they do, they said they sold 40 frames. So it goes out of the business. So 40 frames goes out of the business. So what happens is we're using FIFO. So FIFO states that what comes in to the business goes out first. So what comes in first goes out. So in this case, there's two pieces of inventory that we currently know of, right? So which one of these inventory came in first? Since the $50 one came in last, it's the most recent one that came in. First one, the one that's oldest, is the $40 one. So that's the one that goes out first. So we have, since they said there's 40 going out, 40 sold, 15, the whole 15 goes out, right? Now the remaining is taken away from the next piece of inventory. So that means that since there's 90, right? 15, so what is 40 minus 15? 40 minus 15, that's the one that's the amount that needs to be taken away from the $50 one. In this case is 25 times 50. Yep. Now there's none of the $40 one, right? So when there's none, you don't record it, you just leave it blank. So there's equals 90 minus 25, right? Oh wait, my bad, equals 90 minus 25, 65, and there's 65 remaining of the $50 one, which in this case is, yep, 3250. Okay, so now let's go to the next transaction, or the next effect, which is on the 12th. So purchase 40 frames from Zimmer for $60 plus GST. Alright, so invoice ZF 390. ZF 390. And it said on the 12th of Jan. So 12th of Jan. They said they purchased 40 frames from Zimmer. So purchase 40 frames means that they'll get 40 more to the inventory. So they purchased. So in this case, they mentioned that the price that they purchased it for was $60. Now that's a new piece of inventory, so of course you add it as a new piece of inventory to your balance. So of course when you record it, there's 65 worth of 50, which is the previous one, 65 worth of 50, and then there's the new inventory, because there's $0 worth of the $40 one. Yeah, we don't record that. We have to add the new inventory, which is 46. There's 40 of the $60 ones, in which now this is what happened on the 12th of Jan. So now let's move on to the 16th, I think. Yeah, 16th. So it took 12 frames from the inventory to be displayed at the. So this is a memo. So yeah, again, for advertising, they take out a couple of pieces of inventory for advertising, and it's recorded on a memo. So it's on the 16th. Oh my bad, 16th of Jan. Memo. What was it? Memo 14, I think. What was it? Yeah, memo 14. And then they took 12 frames. So it's an inventory loss this time. So since they took out 12 frames, it goes in the out section. In this case, they took out, okay, so now using FIFO, the one that comes in first is the one that goes goes out last. So in this case, there's no $40 one. The stock for the $40 one is 0. The $60 one came in last, so that goes out last. Now the only one that's remaining is the $50 one, which came in first. So since that came in first, the $50 one came in first, it goes out first. So there's 50 of the 12 that's removed, and then 600 in total. So now when we record our balances, we have 53 of the 50, right? When you minus 12 from 65, you get 53. Yep, and then you get a total of 53 times 50, which is 2,650. Now next, the $60 one is not touched, so it remains. Remember, the other rule is what's not touched remains. So we'll go to the next transaction now, which is on the 19th. So Painters Inc. returned 3 of the frames purchased on 3rd of Jan because they were wrong. Okay, so someone else, an external business, returned it to you. So what's that? That's a sales return. So that's recorded on a credit note. So on the 19th of Jan, it's recorded on a credit note. And what was the price? What was the source stock? It was a credit note 55. So CN 55, right? Now what they said they returned 3. So that's a sales return, meaning that you get 3 more. So there's an addition of 3 pieces of 40 inventory. So yeah. So when you think about it, when they purchased it on the 3rd of Jan, so let's go to the 3rd of Jan, they purchased the $40 one. So let's go. There's 3 of the $40, 3 of the 35 that were purchased, that were valued at $40. 3 of them are returned on this date, on the 19th. So that means we have 120 in total. Okay. Now the $40 inventory is back. There's a balance of 3. So we record that, and then 53, 50 to 650. The $50 one's not touched. The $60 one is not touched either, so they remain. So let's color code this. So remember, The only difference between the previous one and this one is that the previous one uses identified cost and this one uses FIFO. Alright, so to the next transaction now, which is on the 20th, I think. Yep. So sold 60 frames at 111, 110, including GST. So rec 114. So 20th of Jan, rec 114. Okay. So what they said they sold 60. They sold 60 frames. Now, we're using first in, first out, right? So all of the transactions that happened on this date are recorded in the out section because they sold it. They sold 60 frames. So it's going out of the business. So in this case, what came in first? Well, whatever came in first is whatever came in first goes out first. So 340, 120. And then remember, using FIFO, we have the one that goes in first. So the first in is the one that's first out. So when we record this, we get 53 times 50, right? And then we have 460 and 240. So when you add these three together, you get a total of 60, and which is how much they sold in total. So that's the amount. Now 340 and 3 times the $40 ones are taken out, and 53 times the 50 ones are taken out, meaning the balance of the $40 one, $50 one is 0. So whatever is remaining is 40 minus 4 of the $60 one, in which in this case is 36 multiplied by 60. So that's what's remaining on Now we'll go to the next transaction. There's 2 more, I'm pretty sure. If you guys want, you can do this by yourself, but I'm just gonna do it. If you feel confident, just do it by yourself. So on the 22nd of Jan, we'll have the credit note ZF82, CN ZF82. Now on the they say the 22nd of Jan, yep, 22nd of January, they returned 6 to Zimmer frames. So Eclipse Trading, so we returned 6 frames to Zimmer frames. So that means it's a purchase return and recorded on a credit note, right? So in this case, since we returned, we lost 6. We lost. So it goes out of our business. Now, considering that the only stock we have available is the $60 one, that's the one that goes out. So we have 360 in total, and then when we record the balance, we only have 36 minus the 6 that went out of that business. We're at 60, so 1800 in total. We'll color code that. Okay, now the final transaction is the 30th of Jan. So they purchased 25 frames from Zimmer Frames for a total of 1925, including GST. So invoice ZF402. Alright, so on the 30th Jan, invoice ZF402. I'm pretty sure. Yeah, okay. So they purchased 25 frames. So in this case, we might have to do a little bit of math. If we get our calculator, so and if we do 1925, so 1925 divided by how much was it? 25. So we get a total of 77 per 77 per inventory per glass frame. So we'll say that the cost price is 70 and the GST is $7. So we have a new piece of inventory now. So recorded, we have 25 that comes in to our business, $70 they're worth, and then we will do 25 times 70. So that's how much is there. Now when we record this, the only inventory we have, we sold the $40 one and the $50 one, so we don't have any, zero balance. 60 and 1800. And now our new piece of inventory that we have is 25, 70, $70 one, and then 1750. So here is our new inventory card from excise 8.5, right? We have excise 8.5, and in this case we used FIFO, not identified cost, but FIFO. So thank you for watching. We completed chapter 17 inventory in this video. So the part 3 of unit 2 area of study 1, where we looked at inventory cards and using identified costs in FIFO. So in the next lesson we're gonna be looking at managing inventory, which is chapter 18. So see you then.